Welcome to the ALX Show, where we talk faith, family, and all things real estate. Let's get to it. Hello, Patrick. You are
Hey,
new
Brandon.
to the ALX Show, and you are the counterpart to Josh, who has typically been on this episode. But what I'm excited to talk to you today about is a market update on the real estate landscape as you see it, mainly geared toward investors and more financially savvy practitioners that are keen on listening to economic indicators, how you analyze properties. What does the ALX director of investments have to say about what's going on with the market today? So I'll let you take it
Yeah.
there. I know you got some thoughts kind of laid out for where you see the market heading and the ways that you're kind of approaching things right now. So I just wanted to get you on to share some of your perspective with our listeners.
Yeah, absolutely. Man, thanks for having me. Um, Gosh, so that's some pressure to live up to. We'll see if my commentary is worthy of um any dramatic insights. But yeah, it is just a really interesting time in the market, especially for us who are, you know, haven't been in this business for more than 20 years and haven't really gone through multiple real estate cycles. So this is kind of new territory for all of us, and has been an adventure that um, maybe 100 basis points ago and rate hikes would have been a fun stop, but we're still
Mhm, mhm,
riding that wave. But the market today, just to summarize it in a word, would just probably be difficult.
mhm,
Um, the Both on operating properties and in trying to find new properties to buy. And, probably everything that you see and hear is that transaction volume is just kind of ground to a halt, stopped completely. And uh, even in markets that were hot or, kind of the darlings of the last few years, everything is really just slowing down. And groups everywhere who have bought a lot of stuff are now figuring out, hey, how in the world do we continue to do that? How can we keep up? And we've got, you got to keep acquiring properties to keep growing. And the flip side of all of that is you've also got to, if you're an operator, you earn money when you buy and when you sell properties, primarily when you sell properties. And not only has it become difficult to buy properties over the last year and a half, but it's also become really difficult to sell. So everyone is kind of in a holding pattern, wondering when is this going to break and what's going to happen. And um, so everyone just watching really closely every piece of data or potential indicator to say, hey, maybe breakthrough's about to happen. Hey, maybe something's going to change. And has been a lot of parsing Fed transcripts and ways that you never really thought you'd have to do. Um, and so it's kind of where we are right now.
yeah. So Josh has mentioned it's been really difficult and that the I guess the breaking point of when some of those things will unlock and deals will start happening again is really just the Fed cuts. That's what most people are waiting on. Are they going to stop hiking? Are they going to start cutting? I know some predictions is that they're maybe going to cut interest rates maybe 3 times this year. And do you see that that's going to be the kind of I guess the dam break in letting all this capital flow through again? Is that really what people are waiting on?
Probably so. It's fascinating because so much of what we do is tied to Fed guidance and Fed rate movement to a point. And long term rates have to kind of move in concert with what the Fed's doing to really make an impact. So if the Fed starts to cut rates, um, the next immediate question is how quickly do long term notes and bonds catch up, and will there be an immediate buying spree on 5 and 10 year bonds that is going to, push yields downward? Or is the longer end of that curve going to take some time to adjust to what the Fed's doing? And so that's that's one piece of it. I mean, I think the Fed starting to cut rates, the most the biggest benefit of that is just going to be sentiment. And
Mm,
everyone's going to get a little shot in the arm of encouragement and start to say, hey, there is a light at the end of the tunnel. There's probably going to be some movement. And I think that alone, the psychological impact of that will be, I think,
mm,
pretty strong. Because, a 25 basis point cut where we're at right now is not going to move the needle a ton on
okay.
anything. On if you've got a property that you finance with floating rate debt over the last 2 or 3 years, what was generally required was that you would buy a rate cap for that loan. So really all that is basically a ceiling on the how high your floating rate can go. And
Okay.
so for most of us who bought, like, if you took out a loan 2 years ago with a floating rate note and, rates were 25 or 50 basis points, you bought a, a rate cap with a strike price at 2%, say. And what that means, and then you've got the spread on top of where your strike price is. So um, once rates crossed Fed or short term rates cross past 2%, your ceiling, your cap kicks in, and you're only going to pay that plus your spread, no matter how high rates go up.
Mm,
So when uh, Fed starts to cut rates, um, those first, few cuts for as far as like immediate relief on portfolios that people own now, it's really going to be nominal. The real impact is going to be um, when long term rates start to move um, downward and create a little bit uh, cheaper borrowing opportunity, and um, and then what happens to the price of these interest rate caps as rates start to cut. So a huge inhibitor, if you're not going to do fixed rate debt right now and you're going to pursue a floating rate loan, um, you would have to buy, or if you've got an expiring rate cap right now and you feel like, hey, maybe it's in our best interest to extend this loan rather than try and refinance it into a different loan product. The biggest barrier to that right now is the cost of your rate cap. So, I don't know the current numbers off the top of my head, but if you've got roughly a $10 million loan and wanted to buy a rate cap at 2% for 12 months, probably close to $400,000 right now. And so it just doesn't make a lot of sense to do that. But when uh, the Fed starts to cut rates, there will be a repricing of the cap cost. And um, it's that's all based on the forward curve and kind of what the guidance is and direction there. But I think that will be, I don't know how many cuts will be needed for it to like really be a financial benefit to where you can start entertaining that as an option. But short of long-term rates coming down uh, in concert with the Fed cutting rates, that's really your only other option for, getting some rate relief is the price of those caps coming down.
mm. Okay, that's helpful. And I know I know everybody's watching the Fed, and we've talked about that before. But I'm curious, are there other places that you are looking for things to move? Are there places that you're still finding real value in terms of deals or and I know some of this is maybe, ALX's secret sauce and, how you source deals and all that sort of thing. But are there just places that you still feel pretty confident, pretty hopeful and optimistic? And I know in any market, that there's always going to be some bargains that can be had. But they're just harder to find. They're more competitive now, maybe. And so I'm just curious, any kind of like hope for listeners to kind of feel like, okay, some things are maybe shaking loose, or there's just the hot spots of activity to pay attention to, anything like that?
Well, it's a great question. I think uh, broadly, the uh, I don't think that there's huge scale opportunity that you can just like find widely. I think it takes a lot of hunting and searching and working through a lot of different opportunities to find what's, really worthwhile out there. A good example would probably be, and gosh, this is no secret sauce to ALX, and like we are not, you know, doing anything that no one's ever heard of and should be praised for being innovative or whatever. Like we're, you know, interpreting the same data that everyone else is and trying to find, what makes the most sense. But we've beat this drum for a while now, and hopefully not to death to where this sounds repetitive, but over the last 6 months or, maybe 10 months or whatever, what became really valuable, if you're looking to buy, was someone selling that had an assumable loan with a fixed rate that was much less than what you would get if you're putting new debt on a property today. And I mean, intuitively, that is an easy concept, right? Like you go out today, you're trying to buy a property, it's going to be, 5.5%, 6% interest rate if you're on the multifamily side with like a Fannie Mae or Freddie Mac loan. Or you could, assume the note that the sellers got that they fixed 2 years ago at 4%. And the folks who had those properties with an assumable loan are really the ones who are able to sell at good value at a time when no one else was really able to do it. And so on the buyer perspective, that became something that a lot of people started to look for and an attractive option. And so that was one pocket that we had really tried to pinpoint and found a property eventually that, made a lot of sense for us to pursue. And that's great because, you find one of those with a fixed rate that's lower than where you're at today. You can, purchase it and not really have to worry about what's going to happen rate wise. And that the deal works with how you've got it set up currently, and you don't have to, hit some wild metric to try and catch up to where your interest payment's going to be or anything like that. So that's been, a pocket that a lot of people have tried to exploit, not just us. If
Yeah.
that, yeah,
Yeah. Okay. Interesting. Okay. This is kind of a selfish question, so forgive me,
love it.
all of you people out there. But I am kind of a bear typically. Just I'm a perma bear. And so anytime I see some like gloom and doom chart, I'm always like, interesting. Should I pay attention to this? And I saw one a couple of days ago that showed commercial real estate loan delinquencies going up.
Mhm, mhm.
And it matched the kind of trajectory that it did back in '06, '07, '08. And I texted my friend a picture of this chart, he's an investment manager at a credit based fund, large firm. And I was like, should I be like storing emergency food and water, or like pulling all my Bitcoin out of the market, or it's just going wild, just gonna be dramatic. But the idea, and I'm kind of thinking about this in terms of seeing a Goldman research report. This was like maybe a year ago or 6 months ago, and they called it a wall of debt that is maturing this year and especially into next year, as far on the commercial real estate side, and how there's loans that need to be either refinanced or covered in some way. I'm curious, do you have any like real? Is there like merit to that? Is there like a reckoning that is coming? Are you Yeah, are you optimistic, generally speaking? Or, like, how do you assess, like, any of that kind of news that you're kind of seeing out there that people are talking about? Yeah,
Well,
just
this
like
is
it could get really hard in the future.
a great discussion, especially for you and I, because I tend to be the opposite of how your perspective is. I
Okay,
like,
good.
um, it really is something that I have to check is like
Okay.
just trying to find the optimistic view in everything that I digest.
Mm.
Um, which is good, but can also, you really need to check that as best you can. Make sure that you're not just trying to confirm what you're seeing. So
Yeah,
to
and I
hear
don't wanna be
someone,
a cynic either, so, you know?
right, right. And I think just like most things, like the truth probably lies in the middle somewhere.
Mm,
And um, there is like rising delinquencies as far as we can all see is a real thing that's happening. And um, not just in multifamily or uh, centered in any one asset type. I mean, it's kind of happening. The properties that are in the news the most are probably either multifamily or office, and
mhm,
that is happening where delinquencies are on the rise. The next question after that is what what happens? Is there how are the groups who are out of cash able to weather the storm? And if you're going delinquent, you're either working on an alternative solution to raise additional capital to get some cash infusion into your project, or you're a step from beginning the conversation of how do we get out of this or walk away. And the second piece to that is how cooperative are lenders going to be.
mm,
And um, I think everybody is correct when they say, I don't think that lenders want to own a bunch of property. I mean, that's probably the last thing that they want to have happen right now. And I totally agree with that. But I don't know what it's going to truly be like as, um, you know, their portfolios mount up with some delinquency. I don't know how willing to work with some of those groups they're going to be, on the whole. Every deal is probably going to be different. And, um, the bigger institutional owners, frankly, have more ability to walk away in something that they see. I mean, if you look at like the really big giants, they're pretty quick to walk away if they know that like, hey, this thing is turned into a dud. We can, you know, get out, take our losses because we know we can put this capital to work somewhere else that's going to be better.
mm,
And the bigger groups have the ability to do that because they've got, 100 years of trust built up with institutional investor groups that understand the game that they're playing.
mm,
Whereas the smaller groups, like track record is really, really important. You don't want to walk away from a deal that unless you've given every ounce of, putting everything you've got to make sure that it works. And so the smaller, put that in quotes, the not giant operators of the world are going to fight to, protect their investors' money as best they can. And so, um, lenders, I think are going to be more cooperative with that. The biggest difference I see between like, um, 2008 and now is, at least initially, so much of the taking back of properties is on the single family side. Before it really hit commercial properties, and when homes got foreclosed on, it was easy to take them back. I mean, that's a much easier thing to do. So, it's at least is starting a little bit differently in how this is all unfolding than how it did, you know, 16 years ago.
mhm,
And then to make a long answer even longer, the second piece of what you're asking is, about the wall of maturities. And I, my hunch is that that is a fairly overemphasized statistic,
Okay.
at least to me. And maybe that's, you know, eternal bull me, clouding how I should be looking at it. But the the there's two kind of maturity wall stats that you see all the time. There's like the near term one of like, this year there's X amount of commercial loans coming due. And then you've got the one that's like, you know, by 2028, there's like however many trillion of loans coming
Mhm.
due. That one makes me laugh a little bit. Like, because that in, in our world, 5 years is a really long time. Like,
Mhm.
so much will change and can change over that time period
Mhm.
that we're not going to, I mean, the Fed can't even guide like the next 3 months,
Yeah,
you
right.
know,
Yeah.
correctly without, 3 months ago, we were saying, man, we're going to get 6 rate cuts going to start in March. This is going to be awesome. Like
Yeah.
finally relief is here. And here we are now saying like, well, actually that isn't what it's going to be.
Mhm.
Um, so to look out, 3, 4, 5 years and say that there's a kind of a doom of maturities happening, I just don't think it'll play out in that way. I think there'll be a bunch of rate movement before that, and then there'll be a bunch of change in fundamentals before that too.
Mm.
So it won't just be interest rate driven, which is, drives a lot of the discussion right now. But another piece of what is kind of keeping everything grounded, at least in the multifamily world, is rent growth. And so that's a fundamental that has changed really quickly and kind of flipped everything on its head and compounded the effects of really quickly increasing interest rates. And
Mm.
so we know that we're not going to be in that forever too. So, um, 2 years from now, when you've got a loan coming up for maturity and you know that interest rates will likely not be at where they are today. You don't know what that will be at, but you also know that, you probably are going to be having 0% rate growth today still too.
Mm.
So that gives you the opportunity to, boost revenue, in turn grow NOI, have the ability to um, look at your refinance with a totally different picture than what you've got right now. And so I just think by the time that we get to those maturities coming up, that the conversation will be a lot different.
Mm.
Um, but in the near term, the maturities coming up this year, I mean, that one's got a lot more merit. There is a bunch of risk with groups having to come up to refinance and not having the ability to refinance out the entire amount of their debt. And so, um, I don't think that means all of those groups are going to be in trouble. And uh, that's one narrative that's out there, is kind of everyone who's got a loan maturing this year is going to be like, there's going to be a
Right.
bunch of groups who can raise additional capital or get a preferred equity partner or, sell some of their other properties in their portfolio to shore up some ones who need it. I mean, there's a lot out there that I think will limit the impact of all of those maturities. I don't think I'm being too optimistic and saying that, but I guess we'll see.
That's fair. That's fair. That's helpful. For the record, my friend responded back basically that the assets themselves, actual securities, are probably a lot more credible and better assets than they were 10 years ago, 15 years ago. And so the
Yeah.
mortgage holders, have a lot more credibility to them because of the standards that were put in place after the crisis. So he
Hmm.
was he didn't worry about it too much. So that's fair. Maybe
Yeah.
it's just me.
Yeah. Yeah.
And I know that, news is supposed to drum up those kind of reactions. That's the point. But anyway. So what else are you paying attention to over the next, let's say, 6 months? What are some things that you're watching, or just some, kind of final takeaways for listeners to kind of keep their eyes on for the next couple of months?
That's a great question. Um, I think the the other than, and I'll sh- shy away from anything about interest rates because that's what everyone's looking at. But
Yeah.
I think the the big things to watch. I think let's just walk through a hypothetical scenario of if rates stay static. Let's just say rates are unchanged for the rest of the year. What happens? What opportunities are there? Will transaction volume pick up? And like I said a minute ago, I think a lot of that hinges on um, two things. Rent growth ability
Mhm.
is the biggest one. And everyone knows that, we're hitting a supply wave that's kind of cresting right now. And that's really impacted owners' abilities to grow rents, especially in the apartment world. And, um, when does that start to turn? And I think i- if that turns quicker than people expect, then there's a pretty quick uptick in opportunity and in volume. Because what has happened right now is if if you are looking to buy a property, one of the reasons that cap rates got pushed down so much in 2021 or 2022 was that rent growth was so strong. So it wasn't just that your in place NOI was um, driving your decision to buy a property. It was that, hey, gosh, we can get under contract, and by the time we close, we're going to have another 3 months of 12% rent growth that we're going to walk into. So purchasing at a 4.5 cap rate when we go under contract is really going to be a 5 by the time we get to the closing table. And then a year later, our yield on cost is going to be, at 7, and we would like to get there as quickly as we can. And what happened when the rent growth stopped is that, hey, we're buying at a 6 cap now, and we're not planning for any growth for a year. And so when you don't have the ability to bake in upside through your operation, you can't get as aggressive on what you're offering. And I think that's what's been so frustrating for people trying to sell properties right now is you're like, hey, you can get a loan right now at 5.5, 5.6% for this property, and you don't want to buy it at a 6 cap, which would give you positive leverage going in. Like, why is this disconnect happening? I keep thinking that it's just all rent growth driven. It's because, the days are not like knowing that you can take over a property and grow it even 5% in revenue in the first year and, have a different picture. If that were the case today, I think a lot more stuff would be selling. And so I think that's the biggest thing to watch is one, how much supply actually gets delivered. Will there be, delays with stuff under progress and under construction now? Is stuff that's planned, does it get shelved? I think we'll see some of that. And so I think, optimistic again, but I think we might see rent growth uptick a little bit quicker over the next few months than everyone else seems to think. I think I'm kind of on my own island in that, but
Mm.
we'll see.
What I find is so interesting, and I'm not a financial professional. I know some things because of my school and things like that, but what is so interesting, the way you're describing rent growth being a positive, as the more rent grows, the better the investment, obviously. But it's so funny because so much of what I read and things that friends say, and I'm on Reddit or I'm on reading New York Times or listening to political slogans or whatever. Rent growth is such a bad thing. So it's just so funny to always. Anyway, it
Yeah.
doesn't
Oh,
matter for our listeners because everybody gets it. But I just always hearing that kind of stuff is like there's always another side to this story that people don't know.
well, I mean, gosh, as owners of commercial property it's people's residence, like
Yeah,
that
right,
is an important thing too. Like,
right.
um, sticking people with a 20% rent growth might work for 1 year.
Yeah,
Like,
right, yeah.
but I mean, at the same time too, you're trying to cultivate a property that your residents are happy and want to be there
Yeah.
too. And it, um, you've got to make the investment that you set out to make and try and deliver the
Yeah.
results, but also couple with the like human side too of, um, these are, people's lives, and
Yeah.
you are providing the housing for them, and there's not a ton of other options for them
Mm-hmm.
to, find somewhere to dwell. And
Mm-hmm.
so, um, you don't want to just push and push and push and, kind of with that idea of like, we'll just push out the people who can't afford it and fill it with people who can. Like,
Yeah. Yeah.
some of it is understanding who your target renter is, and, meeting a need for that income level too.
Yeah. Yeah, it's a super I didn't mean to, and I'm happy to we can talk about all kinds of things, but it's a super complex topic, but the human side of investing. I'm reading all these books right now as part of this research group that I'm in about how financial transactions are moral transactions. And I'm anyway, so
Yeah.
I just have this like
Yeah.
sensitivity to like, there's people on the other ends. As investors, as residents, as everybody in between, like there's just a lot of complex dynamics that are going on. It's fueling a lot of broader discussions in society, which is neither
It's
here
a
nor there, maybe. But
fascinating idea. I
yeah,
mean, there's a ton of biblical support related to that too.
mm-hmm.
Charging interest alone is a big deal
Yeah,
in Bible times, I mean,
yes,
so, um, yeah, there's definitely a moral component to what we're doing for sure.
yeah, yeah, yeah. Maybe that's next episode. We can talk about all that.
Right.
I like
Right.
that kind of stuff. Anyway, Patrick, thank you. Any closing thoughts to leave our listeners with here as they're kind of scoping out and getting insights from a director of investments at ALX?
Gosh, I um, think my closing insight is not technical at all.
Mm,
But it's just been what has been our kind of thought and prayer and direction for the last few months, like just staying faithful today and,
amen.
just enjoying the daily bread as best we can. And all we can do is, if the last year and a half wasn't clear enough, like we're in control of so little.
Yeah,
And,
amen.
so all we can do is just, uh, be faithful with what's in front of us today, and as best we can, not worry about tomorrow, and know that the since there's so much outside of our control, just doing what's in front of us today and taking a small step every day will probably have the most impact on, how everything ends up turning out 6, 12, 5 years down the road.
Yeah,
So
yeah. Amen.
that's been our,
Amen.
yes.
Amen. Patrick Dunne, thank you so much for joining the podcast, and hopefully we'll have you back on.
Yes. Thanks for having me. I enjoyed it.
All right, we'll see you next time.